Financial statements are the blueprint of a company's financial health. Whether you're an entrepreneur, investor, or improving your financial literacy, mastering them is essential. In this video, we'll break down key components and teach you to read them like a pro. Stick around for actionable tips like this video and subscribe for more insights. Let's boost your confidence in understanding the numbers. 1. Understand the purpose of financial statements. Financial statements serve as a snapshot of a company's financial performance and position. These documents are not just for accountants. They're essential tools for investors, managers, and stakeholders to make informed decisions. The three primary financial statements are the balance sheet, income statement, and cash flow statement. Each provides unique insights. The balance sheet shows what a company owns and owes. The income statement reveals profitability, and the cash flow statement tracks cash inflows and outflows. Understanding their purpose helps you see how these documents fit together to tell a complete financial story. 2. Familiarize yourself with the balance sheet. The balance sheet is like a company's financial photo at a specific point in time, detailing assets, liabilities, and equity. Assets are what the company owns, such as cash, inventory, and property, while liabilities are what it owes, like loans and accounts payable. Equity represents the owner's stake in the business after liabilities are subtracted from assets. The formula assets equals liabilities plus equity must always balance, hence the name. By reviewing the balance sheet, you can assess a company's liquidity, solvency, and overall financial stability. For example, a high level of current assets compared to current liabilities indicates strong short-term financial health. Take note of trends over time to see how the company is managing its finances. 3. Dive into the income statement. The income statement, often called the profit and loss statement, is your go-to document for understanding a company's profitability. It outlines revenues, costs, and expenses over a specific period, ultimately revealing the net income or loss. Key metrics include gross profit, operating income, and net profit. Analyzing these figures helps you see how effectively a company is generating profit from its operations. Look for consistent revenue growth and manageable expenses as indicators of a healthy business. Pay attention to any spikes or declines in costs, as they could signal inefficiencies or emerging challenges. 4. Explore the cash flow statement. The cash flow statement is critical for understanding how money moves in and out of a business. Unlike the income statement, which includes non-cash items like depreciation, the cash flow statement focuses purely on cash transactions. It's divided in 3 sections: operating activities, investing activities, and financing activities. Operating cash flow shows whether the company is generating enough cash from its core operations to sustain itself. Investing cash flow reveals money spent on or earned from long-term assets, such as property or investments. Financing cash flow includes activities like borrowing, repaying debt, or issuing dividends. 5. Learn to spot trends over time. Financial statements become even more powerful when you analyze them over multiple periods. Trend analysis helps you identify patterns, such as consistent revenue growth, shrinking profit margins, or increasing debt levels. Look at year-over-year or quarter-over-quarter changes to gauge performance stability. For example, a steady increase in revenue paired with declining net income might signal rising costs that need to be addressed. Trend analysis also highlights how well a company adapts to market conditions or internal challenges. Comparing trends with industry benchmarks gives additional context, allowing you to determine whether a company is leading, lagging, or on par with competitors. By spotting trends, you can make better predictions about a company's future performance. 6. Focus on key financial ratios. Financial ratios are invaluable tools for interpreting data from financial statements. Common ratios include the current ratio to measure liquidity, the debt-to-equity ratio to assess leverage, and the return on equity to evaluate profitability relative to shareholder investment. These ratios simplify complex data, making it easier to compare a company's performance against peers or industry standards. For example, a high return on equity indicates efficient use of equity to generate profits, while a low current ratio might signal liquidity issues. Use ratios to gain a deeper understanding of a company's strengths and weaknesses by integrating these calculations into your analysis. 7. Check for notes and disclosures. Notes and disclosures accompanying financial statements provide essential context that numbers alone can't convey. These sections explain accounting methods, significant transactions, and any contingencies or risks. For example, a company might disclose pending lawsuits, changes in accounting practices, or details about long-term contracts. Ignoring these notes could leave you with an incomplete understanding of the financials. Pay particular attention to how the company recognizes revenue, handles depreciation, or values its assets, as these methods can significantly impact reported figures. By carefully reading the notes and disclosures, you'll gain insight into potential red flags or hidden opportunities. 8. Look beyond the numbers. Financial statements don't exist in a vacuum. They're influenced by external factors like market conditions, industry trends, and economic policies. For instance, a company might report declining revenue due to a market downturn, which doesn't necessarily indicate poor management. Similarly, a sudden spike in expenses could be tied to strategic investments rather than inefficiencies. Consider external factors such as competition, regulatory changes, and global events when interpreting financial statements. By contextualizing the numbers, you'll make more informed assessments and avoid misinterpreting short-term fluctuations. 9. Compare with competitors. A company's financial performance is best understood in relation to its competitors. Comparing financial statements across companies in the same industry helps you gauge relative strengths and weaknesses. For example, if a company has a significantly higher profit margin than its peers, it may have a competitive advantage. Similarly, higher than average debt levels might indicate financial risk. Benchmarking provides valuable context, helping you see whether a company's performance is truly impressive or simply average. This comparison also reveals industry trends, giving you a broader understanding of market dynamics. 10. Practice and seek expert advice. Reading financial statements like a pro takes practice and patience. Start by analyzing the statements of companies you're familiar with and gradually expand to other industries or businesses. If you encounter terms or concepts you don't understand, don't hesitate to seek expert advice or use resources like financial literacy courses or online tutorials. Understanding financial statements is a lifelong skill that grows with experience. By committing to continuous learning and applying your knowledge, you'll build the confidence and expertise needed to make informed financial decisions. Mastering the art of reading financial statements can transform how you approach investments, business decisions, and personal finances. Which of these strategies do you find most helpful? Let us know in the comments below. Don't forget to like this video, subscribe for more financial insights, and share it with others who want to level up their financial literacy. Let's keep learning together.